This week, everything changed. After a quiet summer rally, U.S. markets were slammed by surprise policy shocks. On August 7th, a sweeping round of U.S. import tariffs will go into effect, spooking investors and rattling markets globally. Meanwhile, trend-following hedge funds just posted their worst half-year since 1998, down nearly 10%. Volatility is up, liquidity is drying up, and if you're trading like it's a normal market, exhale sharply. You're already behind. Thoughtful. In this video, I'll break down 3 pro-level strategies I'm using right now that are built for exactly this kind of chaos. Let's look at what's really happening. The S&P 500 is down 3.5% this week, small by crash standards, but deadly for trend models. Why? Short pause. Because this isn't a clean trend reversal. It's chop. It's sudden spikes. It's sentiment-driven swings caused by macro headlines. Hedge funds running systematic models, like CTA trend following, got blindsided. Algorithms expected continuation, but the market reversed. Even professional funds are bleeding. That's your signal. When models break, discretionary traders win, if you know what to use instead. Strategy number 1. Pairs trading. It's a market-neutral approach. Instead of betting on direction, we bet on relationships. Think CVS and Walgreens, 2 pharmacy giants. If one stock drops 4% and the other holds steady, they're likely to converge again. You long the weak one, short the strong one. If they move back together, you profit, even if the overall market drops. This strategy is working especially well in this environment because it filters out the noise and protects you from market-wide panic. Strategy number 2. Momentum breakouts with pyramiding. The key in this market is not to overcommit. Instead of full-size entries, use scaling techniques. You start small at the breakout, add as the trend proves itself. Use a 3-step system. Entry 1 on breakout, with volume entry 2 on minor retest, entry 3 on strength confirmation. Target stocks like NVDA, Meta, SMCI. Tech names showing resilience even in pullbacks. This style of trading keeps you in winners while controlling risk in a jumpy environment. Strategy 3. Fade the panic. When fear takes over, price overshoots value. This is where mean reversion comes in. Look for RSI below 25 or 20. Check for price outside of Bollinger Bands. Then wait for a bullish reversal pattern, like a hammer, an engulfing candle, or a bullish divergence. This works best on names that got punished unjustly, like AMD, AAPL, or IWM. You're not trying to catch the exact bottom. You're fading exhaustion with structure and discipline.